Welcome back to the Deep Dive. Today we're cutting right through the jargon to look at a company that is really caught in the ultimate squeeze. We're talking about Aimfinity Investment Corp, AIMA, or AIMA, and it's all about their desperate last-ditch effort to merge with a health tech company, Docter Inc. Okay, let's unpack this. We are looking at the final days of a special purpose acquisition company, a SPAC. And for anyone new to this, a SPAC is basically a blank check company. It's formed just to raise public money and then, find a private company to take public. The clock is always ticking on these things. And for AIMA, it's about to strike midnight.
That time pressure is really the whole story here. AIMA has hit a critical point, and you can see it in like 4 key facts that just scream risk. First, they got delisted from NASDAQ, moved to the OTC markets back in May. That's a huge blow to their credibility.
Oh, absolutely. A killer for institutional interest.
Exactly. Okay. And second, management itself issued a formal warning. They said there's substantial doubt about the company's ability to continue as a going concern if this merger fails.
Substantial doubt. Wow, that's the regulatory kiss of death, isn't it?
It's the loudest alarm bell they can ring. Third, the SPAC has seen this relentless flight of public investors. I mean, huge waves of share redemptions have just gutted the cash they had for the merger.
Right.
And that all leads to the fourth and most urgent point. The final hard deadline to get this deal with Docter Inc. done is December 28, 2025. It's either succeed in the next few days or liquidate.
To really feel the weight of that deadline, you have to look at the wreckage left by those shareholders fleeing. This isn't just a few people selling. It's a total vote of no confidence.
Yeah.
What are the numbers on that trust account drain?
The numbers are pretty stark. In just the first 9 months of 2025, AIMA saw almost 2 million Class A shares redeemed.
2 million.
Yeah, and that pulled nearly $24 million right out of the trust account. That's money that was supposed to go to the target company.
$24 million gone in under a year. That is an unbelievable amount of capital flight. It just shows there was, zero faith in this deal succeeding at its original value.
It completely changes the deal's economics.
Right.
If you just track the balance, the trust account started the year at a healthy, $37 million? Mm-hmm. By the end of September 2025, it was down to just over $14 million. Yeah. So well over half the fund just evaporated.
And that wasn't even the end of it. There was another wave of redemptions after that October extension meeting, right?
Correct. After that meeting on October 27th, another 572,000 shares were tendered. That pulled out another roughly $7.36 million. The shareholders are clearly saying, I'll take my $10 back now. Thank you very much.
So what does that do to the overall structure when all those shares are redeemed?
It's huge, and this is a critical detail for investors. Every time a Class A share is redeemed, the warrant attached to it is just. It's automatically forfeited and canceled. So it shrinks the pool of potential future dilution, which is good for those who stay, but it also signals a total failure of the original plan. The deal just gets smaller and smaller.
But here's the crazy part, the financial paradox. You've got this company facing total failure, yet if you look at their income statement, they're technically profitable. How does a shell company facing liquidation even make money?
It's purely a financial illusion. For those 9 months, AIMA reported a tiny net income of about $117,000. But that profit, quote unquote, has nothing to do with business operations.
Right, it's just interest.
Exactly. It was generated entirely by the $630,000 in interest they earned on the cash that was just sitting in the trust account. That interest income just happened to be more than the $500,000 they spent on, lawyers and accountants.
So they're making money on their savings while they burn cash on fees. Which brings us back to that going concern warning. If all that cash is locked in the trust, what does their day-to-day liquidity look like?
This is where you see the sheer desperation. As of September 30th, AIMA had, get this, $3,517 in cash available for working capital.
Wait, $3,500, that's it? For a public company?
That's it. We're talking petty cash levels.
That's less than my emergency fund.
Exactly. And you have to contrast that tiny cash pile with their working capital deficit, which was almost $2.8 million.
Wow.
So they're nearly $3 million in the hole on their short-term bills. They can't pay their lawyers next month. This is precisely why management had to issue that substantial doubt warning.
So if the public investors are gone and the company is basically broke outside the trust, who is keeping the lights on, this has to be the sponsor, right? This is their lifeline.
It's all on the sponsor's dime now. And it really shows how desperate they are to save their initial investment. This December 28th deadline is just the latest stop on a very long, very expensive road of extensions.
Explain that process.
Yeah.
How long has this been going on, and what does it actually cost them to buy another month?
Oh, they've been amending their charter to get extensions for a long time, well before 2025. The most recent one lets them extend monthly, up to 9 times. But each extension costs money that the sponsor has to deposit into the trust.
And how much have they poured in just to keep this thing alive?
By the end of September, the sponsor had already deposited over $1.8 million just for these extensions. But that's only part of it. They're also acting like a bank for the SPAC, giving it working capital loans.
So on top of the extension money.
On top of that, they had over $1.5 million outstanding in working capital loans, plus another $334,000 in extension loans.
Wait, so the sponsor is literally the lender of last resort for its own shell company.
Mm-hmm.
Is that not the ultimate moral hazard of the SPAC model? They're funding a deal public investors have rejected just to save their own skin.
That is precisely the dynamic. It's a classic sunk cost fallacy. For them, closing the deal is the only way they can salvage any of their initial investment. And that desperation led to a really big financial move back in the spring.
Here's where it gets really interesting. They converted that debt into equity. Tell us what that move signifies.
Right. On April 8th, the sponsor took $1.5 million of those loans and converted them into 150,000 private units. This is a huge deal for 2 reasons.
Okay.
First, it cleans up AIMA's balance sheet. It gets rid of a massive debt they obviously couldn't pay back with $3,000 in the bank.
And the second reason?
It increases the sponsor's direct ownership stake in the future company, PubCo. They're essentially saying, we're all in. We will trade our cash loans for illiquid equity just to make this look viable. It shows they are absolutely not walking away.
So let's talk about the prize they're all chasing. This target company, Docter Inc. What exactly are they, and what does the deal look like?
Docter Inc. is described as a Taiwanese health technology company. They develop innovative health monitoring solutions. The deal itself was signed way back in October of 2023. It's been a long engagement.
And the actual closing is a 2-step process, right? It's a bit complex.
Yes, it's a pretty standard SPAC move to simplify things. There's a reincorporation merger and then an acquisition merger. The end result is a new publicly traded entity, PubCo, with Docter as a subsidiary.
And after the closing, who's in charge?
Control shifts to the operating company. The new board will have 5 directors. 3 will be designated by Docter, so they'll have the majority, and 2 will be from the sponsor. Pretty typical.
Now let's get to the underwriting fees.
Yeah.
I always find this part tells you how desperate everyone is. The original fees were pretty substantial.
They were. The original deferred commission was over $2.8 million, but the renegotiation in June, that tells you everything. The underwriters agreed to slash that fee all the way down to just $80,000 in cash.
$80,000. Down from almost $3 million.
$80,000 in cash, plus about 133,000 shares in the new company at closing.
Why on earth would the bankers agree to that? To write down almost $2.7 million?
Because the alternative is liquidation, where they get 0. It's a massive signal. The bankers have basically given up on the deal's original value. They're taking a tiny bit of guaranteed cash and some lottery ticket shares because it's better than nothing. It confirms this deal is just about survival at this point.
That is an extreme willingness to take a haircut.
Yeah.
So what about the incentives for Docter Inc. to actually perform after this all happens? What's the earnout for their stockholders?
The earnout is key because it ties their payoff directly to real-world performance. Docter stockholders can get up to 2.5 million extra shares, but only if they hit specific device sales targets.
And what are those targets?
They get 1 million shares if the new company sells at least 30,000 devices in fiscal year 2024, and then another 1.5 million shares if they sell at least 40,000 devices in fiscal 2025.
So it's all about pushing actual product out the door.
Exactly. It keeps the founders focused on building the business, not just propping up the stock price.
You know, this whole Aimfinity story is just a perfect case study of what happens when a SPAC goes wrong. Let's put this whole mess into the broader context of SPAC risk for a second.
Well, the delisting is the first big piece of context.
Right.
Moving from NASDAQ to the OTC markets is a big deal. It means less liquidity, less visibility. And while the goal is to get the new company, PubCo, back on NASDAQ, that's no guarantee.
And we know from all the research that the SPAC structure itself is kind of loaded against regular investors because of all the fees and dilution.
That's the consistent finding, yeah. The research shows that the target company, in this case Docter Inc., might only see about half the cash that was initially raised. The rest just gets eaten up by fees for the sponsor, the bankers, the lawyers. AIMA is a textbook example of that cash burn.
And the post-merger performance data for SPACs in general, it's not pretty, is it? It sort of justifies the redemptions.
It absolutely does. SPACs that merged during the boom, they have just performed terribly. On average, they lost over 60% from that initial $10 share price, way worse than traditional IPOs. AIMA's sector suffered a bit less, but yeah, the redemptions show investors expect it to follow that same downward path.
So what does this all mean? We have a SPAC that is technically earning interest, but is operationally insolvent with $3,000 in the bank. The trust fund has been gutted. The sponsor has converted millions in debt to equity. It all comes down to this deadline, December 28th. This deal lives or dies in the next few days.
The takeaway is just this incredible tightrope walk. The sponsor's actions show they are completely committed to closing, but that going concern warning and the empty bank account mean that if they miss that December 28th deadline, the only outcome is liquidation, period.
Which brings us to our final segment. This is not financial advice.
Yeah.
We pitch an outrageous but plausible trade idea based only on the data we've just discussed.
Right. So given this binary outcome, it's either total liquidation or a last-second messy closing, you have to look for the asset with the most asymmetric payoff, and that would be the warrants.
The AIMWF warrants.
Exactly. The Aimfinity warrants. They have an exercise price of $11.50, and they trade for, pennies on the dollar right now. The common stock is just too risky with liquidation looming.
But the warrants give you 5 years of runway if the deal actually closes.
Precisely. So the outrageous but plausible idea is to buy the warrants. You're leveraging the really low cost against the extreme tail risk of success. You're basically betting that the sponsor, after sinking millions into this, is simply too deep to let it fail now.
You're betting on their desperation.
100%. If the deal closes on the 28th, the warrants survive. You get 5 years to wait for the stock to just maybe recover. It's a strategy that completely ignores that scary going concern warning and bets everything on the sponsor's need to cross the finish line no matter what.
A pure gamble on the sunk costs of the insiders. What a dramatic, high-stakes way to end this deep dive. Thank you for walking us through the wild financial gymnastics here.
My pleasure. Hopefully get some insight into the extreme risks you see in these final hour deals.